Okay, so let's set the stage here. It's August 11th, right?
Yep.
B2Gold executives are dialing in for their Q2 2026 earnings call.
Yeah.
The operator opens the line, and the CEO immediately drops a bomb. He announces they've temporarily halted trading on their own stock.
Right at the bell.
Right at the opening bell. I mean, you do not see that happen at the start of a scheduled earnings presentation.
No, it completely shatters the normal routine.
It really does. So today's deep dive is taking a talk tickers approach to this just, wildly chaotic quarter.
And we really need to cut through the noise on this one.
Exactly. We are going data forward, we're stripping out the Wall Street jargon, and we want to give you an actionable, opinionated look at what is actually happening under the hood of B2Gold.
Because there's a lot happening.
Look, there's so much. We've got a trading halt, we've got a catastrophic fire at a remote site, massive accounting distortions, and a huge regulatory breakthrough in West Africa.
All colliding in just one 3-month window.
Right. Just a single quarter.
Honestly, it's a phenomenal case study in why you simply cannot trade mining stocks off of headline press releases.
Yeah, because the headlines look totally different from reality, right?
Completely different. The superficial metrics from this quarter tell a story that is just, completely divorced from the operational reality on the ground.
Right.
To figure out where B2Gold is heading, you have to dissect the actual machinery of their cash flow.
Which is pretty messy right now.
Yeah, because right now it's being heavily distorted by financial engineering from past years.
So let's hit those headline numbers first, because the mismatch here is just staggering.
It really is.
If you just pull up the summary data, right, B2Gold reported $417 million in net income.
Wow.
Which is 31 cents per share.
Right.
In a vacuum, for a mid-tier gold producer, that looks like a blowout quarter.
Oh, absolutely. People see that and think, they're printing money.
Right, but when you dig into the balance sheet, that massive income number is a complete mirage. It's driven almost entirely by a $325 million one-time
game, yeah.
From selling their 70% interest in the Fingold properties in Finland to Agnico Eagle, plus some unrealized gains on financial derivatives.
Which, that means it has absolutely nothing to do with their core business of mining and selling gold.
Nothing at all.
When you strip out that one-time asset sale and look at their adjusted net income, the actual profit from their operating mines.
Yeah.
It collapses to just $41 million.
Oh, man.
Or 3 cents per share.
3 cents, from 31 cents down to 3 cents.
Exactly.
And even that 3 cents a share masks the real crisis on the balance sheet, which is the free cash flow.
Right. The cash is what matters.
Always. For Q2, free cash flow was negative $258 million.
Just brutal.
It really is. It's the corporate equivalent of checking your Zillow app, seeing your house value went up by $300,000 and claiming you've had a wildly successful financial quarter.
Right, while your checking account is actually overdrawn by $250,000.
Exactly. And you have no cash to pay the electric bill.
That is a perfect analogy.
They are bleeding cash while sitting on top of highly productive gold mines during a robust gold market.
And that is the paradox that spooks the market.
Yeah, you have to ask how a premier operator actually loses $250 million in cash in a 90-day period.
Right, and the answer is that the mines themselves, Fekola in Mali, Masbate in the Philippines, Otjikoto in Namibia, they actually performed exceptionally well.
They did?
Yeah, they beat internal production targets.
Wow, so they're pulling the gold out just fine.
Exactly. The massive cash drain wasn't a failure of engineering or geology.
Okay, so what was it?
It was a financial squeeze driven by a perfect storm of heavy tax obligations, a literal fire at a development asset, and some incredibly heavy financial baggage.
Ah, the baggage.
Yeah, stemming from how they funded their operations years ago.
Okay, so let's pull apart that financial baggage, because that's crucial.
Definitely.
Specifically, I want to talk about the hedging strategy. The CFO explicitly blamed the negative cash flow on 2 financial instruments.
Right, the collars and the prepays.
Exactly, gold collar contracts and gold prepay contracts.
Yeah.
Looking at the structure of these prepay contracts, it's clear they essentially took a massive payday loan to fund infrastructure buildouts in the past.
That's a great way to put it.
Right. They took the cash up front, and in exchange, they promised to deliver physical gold in the future.
Yeah.
And in this specific quarter, those prepay contracts consumed 30% of their total sold ounces.
which is just a brutal drag on operating margins.
I can imagine.
I mean, think about it. For every 10 ounces of gold, they painstakingly blasted, crushed, processed, and shipped this quarter.
Yeah.
They received 0 new cash for 3 of them.
Wow. 0 cash.
0. Yeah. They're paying 2026 labor, fuel, and equipment costs to pull that gold out of the ground, but the revenue for it was already spent years ago.
It fundamentally breaks the leverage you're supposed to get in a bull market.
Absolutely.
I mean, the whole thesis of buying a gold miner rather than physical bullion is that your margin should expand exponentially as the price of gold rises.
Right. You want that operational leverage.
Exactly. But B2Gold kind of kneecapped that leverage with their gold collar contracts.
They really did.
They capped their upside to guarantee a floor price. And this quarter, because gold prices surged past their caps, they had to recognize $71 million in realized losses.
Just on those collars alone.
Yeah, just on the collars. If they had just ridden the spot price, their adjusted net income would have been 8 cents per share instead of 3 cents.
It's a huge difference. But to understand the why behind this, you have to look at the mechanics of mine financing.
Okay, walk me through that. Why do they do this if it hurts them so much?
Well, mining companies generally do not enter into restrictive collars or prepay facilities because they think it's a brilliant speculative trade.
Right, they aren't day traders.
Exactly. They do it because building a mine is incredibly capital intensive.
Oh, for sure. Billions, right.
Yeah. When you approach a syndicate of banks for a $500 million construction loan, those banks demand downside protection.
Ah, so the banks force their hand.
Pretty much. They force the company to hedge a percentage of their future production to guarantee the debt can be serviced, even if the gold price collapses.
Makes sense from the bank's perspective.
Right. So B2Gold made these deals in a totally different macro environment to de-risk their development pipeline.
But now the environment has changed.
Exactly. Unfortunately, when the macroeconomic cycle turns and gold hits record highs, those historical risk mitigation strategies turn into massive financial anchors.
It's the ultimate cost of capital.
Yeah.
They protected their downside, but the opportunity cost is costing them hundreds of millions of dollars in missed revenue today.
It's painful to watch.
And on top of servicing that financial baggage, they had to swallow a severe physical setback too.
The fire.
Right, at their Goose mine project in the Canadian Arctic, a major fire tore through the crushing circuit in April.
Which is just, operating in the Arctic Circle is already one of the most logistically unforgiving endeavors on the planet.
You can't even imagine.
You have a very narrow window to move heavy equipment over ice roads.
Right, the ice roads literally melt.
Exactly. So when you lose a primary industrial rock crusher to a fire in a location like that, the timeline and cost implications are severe.
The company recorded $16 million in direct remediation costs during Q2.
Wow.
Just to manage the downtime and the immediate aftermath of that fire.
And that's pure cash outflow with 0 return.
Right, it doesn't build the mine, it just stops the bleeding.
Yeah. And while safety was maintained and the emergency response was handled really well, the operational pivot required immense agility.
What did they have to do?
Well, they couldn't wait a year for a custom-built stationary crusher to be manufactured and shipped up north.
Because they'd missed the ice road season.
Exactly. They had to immediately source a massive mobile crusher from Metso, transport it to the site by July, and begin commissioning it to bypass the damaged circuit.
That sounds incredibly expensive.
It is. They anticipate this workaround will push their crushing capacity past 3,000 tons per day in the short term, but the capital expenditure required to execute that pivot is a major contributor to the negative cash flow we saw this quarter.
So we have the cash drain from the prepay deliveries, we have the realized losses from the price collars, and the unexpected millions spent fighting and fixing an Arctic fire.
It's a lot.
It is a lot,
Yeah.
But none of that explains the trading halt at the beginning of the earnings call.
No, that was something else entirely.
Right. That halt was triggered by news out of Mali regarding the Menankoto exploitation permit.
The big one.
And given that Fekola is their flagship asset, it's responsible for roughly half of the company's total production. I view this permit as the single most important variable in B2Gold's entire valuation model.
Oh, it absolutely is the linchpin of their long-term strategy.
Tell me why it's so critical.
Well, the main Fekola mine is a massive cash generator, but open pit mines are finite assets.
Right. Eventually you just run out of ore.
Exactly. You eventually dig to the bottom of the economic ore body.
So they need more ore to feed the beast.
Right. To sustain that processing facility and keep the cash flowing into the 2030s, B2Gold needs to feed it with new rock from satellite deposits.
And that's where Menankoto comes in.
Yep. Fekola Regional, which is located about 20 kilometers away, is that lifeline. The Menankoto permit is the sovereign authorization required to physically break ground and extract that ore.
And they have just been sitting on their hands waiting for this authorization.
For a long time.
Right. They've already invested heavily in the infrastructure. The haul roads are built. The heavy machinery is parked. The personnel are hired.
We're just waiting for a signature.
The fact that they had to narrow their 2026 production guidance because a piece of paper wasn't signed shows the sheer power host nations hold over these billion-dollar assets.
Oh, absolutely. And the delay was a direct result of sweeping legislative changes within the host nation.
Right. The new mining code.
Yeah. Mali recently enacted the 2023 Mining Code, completely overhauling how they govern natural resource extraction.
And that just froze everything.
Exactly. When a government rewrites its fundamental mining laws, the entire bureaucratic apparatus freezes.
So nobody knows who's in charge of what.
Pretty much. New ministries are formed, new regulatory commissions have to be seated, and new state-owned entities have to figure out their own operational mandates.
Like Mali's newly created SOPAMIM, right? The one that manages the state's stakeholder interests.
Yes, exactly. So B2Gold essentially became the guinea pig for this new bureaucracy.
That's a tough spot to be in.
It is. They had to navigate an untested regulatory framework, which requires relentless diplomacy.
And the market hates that kind of uncertainty.
Oh, the market despises it. The stock was penalized for every month that permit was delayed.
Right, so that explains the trading halt. It was necessary because the moment that permit was finally signed, the existential risk to the Fekola Complex just evaporated.
Precisely. With that signature, B2Gold is instantly authorized to begin pre-stripping operations.
What does that mean for the folks listening?
It means moving the massive volumes of waste rock that are covering the gold deposit so they can actually expose the ore for processing.
Oh, okay.
The signing of the Menankoto permit fundamentally transitions Fekola Regional from a speculative development project into a confirmed producing asset.
Which is huge. And that brings us to the forward-looking guidance.
Right, looking ahead.
Q2 was undeniably painful. We've mapped out the cash bleed, the operational headaches, the fire.
Yeah, it was ugly.
But the management team is very aggressively pointing the market toward a specific inflection point.
And that point is the year 2027.
Exactly. And looking at the timeline of their debt instruments, 2027 is when the financial handcuffs finally come off.
That is the core thesis driving the stock right now.
Because all those bad contracts expire.
Yes. The gold prepay contracts, the ones that consume 30% of their Q2 sales, for zero cash, they officially concluded in June 2026.
Wow, so that's already done.
The debt has been satisfied, yeah.
Okay, what about the collars?
The gold collar contracts, which forced them to sell at a capped price and eat $71 million in losses this quarter, they expire entirely at the end of December 2026.
So on January 1st, 2027, this company becomes 100% unhedged.
Unhedged and fully exposed to the spot price.
That's incredible. Every single ounce they pull out of the ground will be sold at the spot price.
Yes.
If gold is trading at historic highs, that revenue flows directly to the bottom line without being siphoned off by derivative caps or historical debt deliveries.
And that's exactly what you want. The CFO explicitly stated that free cash flow will rise dramatically as these burdens fall away.
It has to, right?
Yeah. And that financial liberation coincides perfectly with their operational ramp up.
What's the timeline on the operations?
Well, at the Goose mine, the remediation from the fire and the integration of the new mobile crushing circuit is projected to bring them to a steady state processing rate of 4,000 tons per day by the middle of 2027.
Okay, so that's humming along nicely by then.
Exactly. Simultaneously, Fekola Regional will have completed its heavy pre-stripping phase.
Right, the dirt moving.
Yeah. And they're targeted to deliver over 150,000 ounces of gold per year, starting in 2028.
So you have a convergence of zero financial hedges and peak operational throughput.
It's a really powerful setup.
It is, but we have to look closely at the cost of getting there.
Yes, the costs.
Because the guidance on their all-in sustaining costs, or AISC, is glaring.
It's a big number.
Management lowered their AISC guidance, but the range is still sitting at $2,370 to $2,550 per ounce sold.
Right.
For anyone tracking the broader mining sector, an AISC of $2,400 is stratospheric.
It really is. Industry heavyweights like Newmont or Barrick are typically fighting to keep their AISC down in the $1,300 to $1,500 range.
Exactly. If gold were to pull back to $2,000 an ounce, B2Gold would be severely underwater at these cost levels.
It is a critical metric to scrutinize. But you have to distinguish between cash operating costs and the broader all-in sustaining costs.
Break that down for us. What's the difference?
Well, their actual cash operating cost, the direct expense of labor, explosives, fuel, and maintenance to run the mines, is projected at a very healthy $1,155 to $1,280 per ounce.
Okay, so the day-to-day mining is fundamentally efficient.
Yes, the mines are running great. The reason the AISC is inflated to over $2,300 is due to the massive front-loaded capital expenditure cycle they are trapped in right now.
Right, because AISC includes the capital needed to sustain the business long term.
Exactly.
And right now, their sustaining capital is bloated because they're paying for the Goose mine fire remediation.
Plus, they are funding the massive Phase 8 pushback at the main Fekola pit to access deeper ore.
And they are mobilizing all that heavy earth-moving equipment for Fekola Regional.
Yes. They're basically absorbing years of infrastructure costs into a single reporting period.
And this is where accounting metrics can obscure economic reality.
They really can. They are investing heavily today to secure cheap ounces tomorrow.
So the high AIC is temporary.
Very much so. Management expects the final 2026 AISC to come in at the very bottom of that guided range. And as those capital-intensive construction and stripping phases conclude next year, that AISC figure should plummet.
Perfectly aligning with their return to unhedged spot prices.
Exactly. It's all timing.
That sets up our bottom line verdict perfectly.
Let's hear it.
We're looking at a company that just posted a $250 million negative cash flow, suffered an industrial disaster at a key growth asset, and is guiding for an AISC that looks terrifying on a spreadsheet.
Sounds terrible when you put it like that.
It does. Yet the underlying mechanics suggest that Q2 2026 is the absolute peak of the bad news.
I agree completely.
The fire is being managed, the Mali permit is secured, and the restrictive hedges evaporate in a few months.
Yep.
For a retail investor with a time horizon extending past 2027, the setup here is incredibly bullish.
It really is. The market is backward-looking and has heavily discounted the stock based on the operational friction of the past 2 years.
Right. Wall Street has a short memory.
Very short. The chairman of the board, Kelvin Dishnisky, even admitted on the call that the share price performance has been unacceptable to them.
I mean, they know the stock is cheap.
Oh, they know. The market is pricing B2Gold as if the heavy capital spend and the restrictive hedges are permanent features of the business, rather than temporary hurdles that are actively expiring.
Talk is cheap, though. Any executive team can build a PowerPoint deck promising a golden future in 2 years.
Sure, you see it all the time.
But the actionable signal for retail investors is capital allocation.
Follow the money.
Exactly. You don't buy back your own stock when you are bleeding $258 million in cash unless your internal modeling proves beyond a shadow of a doubt that a massive wave of cash flow is imminent.
And their capital allocation speaks volumes.
What are they doing with their cash?
Well, through the first half of 2026, they returned $224 million to shareholders.
That's a huge chunk of change.
It is. That includes a steady dividend, but the really aggressive move is the share repurchase program.
The buybacks.
Right. Under their normal course issuer bid, they bought back roughly 35 million shares for $172 million this year.
Wow.
And in the second quarter alone, the exact same quarter they were fighting the Goose fire and delivering 30% of their gold for zero cash, they spent $92 million to retire 19 million shares.
That is the defining signal.
It's massive.
They are looking at their discounted share price, looking at the impending end of their prepay contracts, and realizing that the highest return on investment they can possibly generate is buying their own company on the open market.
It's an aggressive, confident maneuver.
Yeah, they are absorbing the short-term liquidity crunch to permanently increase the per-share value for long-term holders.
It requires immense capital discipline. They are essentially arbitraging the market's impatience.
I like that phrase, arbitraging impatience.
It's true.
Yeah.
By the time the broader market wakes up to the unhedged cash flow generation in 2027, the share count will be significantly reduced.
Concentrating the gains for the investors who held through the friction of 2026.
Exactly.
So the Talk Ticker's thesis is clear. The Q2 headline numbers are ugly, but they are a rear view mirror.
Yep. strictly in the past.
The future is unhedged, fully permitted, and highly leveraged to the gold price.
It's a great setup.
However, before we wrap up, there is a macro element hidden in the details of that Menankoto permit that we really need to address.
Oh, yes. The mining code.
Right. Because it has massive implications not just for B2Gold, but for any investor holding mining equities right now.
Yes. We discussed how vital the Menankoto permit is for Fekola's future. But the terms of that permit represent a fundamental shift in the geopolitical landscape of mining.
How so?
Well, the existing Fekola mine was permitted under Mali's 2012 mining code.
Okay, the old rules.
Right. Menankoto, however, was negotiated under the new 2023 mining code.
And I'm guessing the new rules aren't as friendly.
Not at all.
Yeah.
The financial demands placed on the company under this new code are significantly more aggressive.
The numbers are stark. Under the 2023 code, Fekola Regional will be subject to a flat 30% corporate income tax rate.
Right.
Without the long-term tax holidays that used to be standard in the industry to incentivize development.
Go on.
They also instituted a specialized ad valorem tax that was bumped up by 2%. But the absolute heaviest blow is the equity structure. The state of Mali now demands a 35% ownership interest in the project.
35% equity right off the top.
That is massive.
It is. And it yields priority dividends to the state before the public shareholders see a return.
Wow.
This is the new reality of resource nationalism.
It feels like a sea change for the whole industry.
It really is. As gold prices stabilize at historic highs, host nations across Africa, Latin America, and Asia are recognizing the immense value of their sovereign resources.
They want a bigger piece of the pie.
Exactly. They are no longer content with simple royalty streams and payroll taxes. They want massive equity stakes and immediate corporate tax revenues.
And I mean, you can't blame them. It's their sovereign wealth in the ground.
Absolutely, it's their country.
But from an investment perspective, it completely alters the net present value calculations for future mines.
It totally changes the math.
If every new discovery in a developing nation now requires surrendering a third of the project's equity to the host government, the margins for the mining company, and by extension the retail investor, are drastically compressed.
It forces a reckoning in global capital allocation, really.
How do you mean?
Well, building a modern gold mine costs billions of dollars and carries immense geological and operational risk.
Right.
Historically, mining companies demanded outsized potential returns to justify taking on those risks in complex geopolitical jurisdictions.
Because things can go wrong.
Things go wrong all the time. If host nations squeeze the margins too tightly, the capital will simply strike.
The companies will just go somewhere else.
Exactly. Mining companies will redirect their exploration budgets back to safer, lower tax jurisdictions like Nevada, Ontario, or Western Australia, even if the ore grades are lower.
Or conversely, investors will just have to accept a permanent geopolitical premium.
Yeah, that's the other option.
We might have to adjust our expectations and realize that the era of a Western mining company pulling 80% margins out of a West African asset is just over.
It might be a thing of the past.
Mali's 2023 code might not be an outlier. It might be the blueprint for the next decade of global resource extraction.
Which is a sobering thought.
It is a dynamic that requires every mining investor to rigorously evaluate the political jurisdiction of their portfolio, not just the drill results.
It's the ultimate balancing act.
Host nations need foreign capital and expertise to build the mines, and mining companies need the host nation's ore.
Exactly. But as the pie gets bigger due to rising gold prices, the fight over how to slice it is becoming much more aggressive.
Everyone wants their cut.
Yep. The Menankoto permit proves that agreements can still be reached, but the cost of doing business has unequivocally gone up.
The bottom line on B2Gold is that they are navigating this exact transition.
They're right in the thick of it.
They are paying the toll in Mali, they are fixing the infrastructure in the Arctic, and they are finally shedding the historical debt that choked their cash flow this quarter.
It's a lot to manage, but they're getting through it.
It is a story of extreme short-term friction setting the stage for a massive operational pivot.
That's the takeaway.
Keep a close eye on their Q3 and Q4 AISC to ensure the capital spend is actually rolling off as promised, and watch the gold spot price as we head toward that unhedged horizon in 2027.
It's going to be fascinating to watch unfold.
It really is. We will see you on the next deep dive.